Before we begin, please note that I am not a licensed insurance agent or a financial advisor. This video is for informational and educational purposes only and should not be considered legal or financial advice. The world of insurance is complex and policies can vary significantly by state and by company. You must consult with a qualified and licensed insurance professional in your state to discuss your specific situation and ensure you have the appropriate coverage. Imagine this. You're out on a Friday night, the dinner rush is popping, and you're stacking orders making great money. You're on your way to a customer's house, a routine drop-off, when someone runs a stop sign and T-bones you. It's not your fault, but your car is wrecked. You're shaken up, but you think, okay, that's what I have insurance for. You call your personal auto insurance company, the one you've been paying faithfully for years. You file the claim, and then the agent asks the one question that changes everything. What were you doing at the time of the accident? You answer honestly, I was delivering an order for DoorDash. There's a pause on the other end of the line, and then you hear the words that every single gig worker dreads. I'm sorry, but your policy doesn't cover commercial use. We are denying your claim. Suddenly, you're on the hook for everything. The thousands of dollars to repair or replace your car. The rental car you need to keep working. All of it. Your income source is gone, and you're facing a mountain of debt, all because of a 5-word phrase hidden in the fine print of your policy. Business use is not covered. This isn't a scare tactic. This is a reality that plays out for DoorDash drivers across America every single day. And it's happening because of a massive, dangerous gap between what drivers think is covered and what is actually covered. Most drivers fall into one of two camps. Either you believe your personal car insurance has your back, which, as we just saw, is almost certainly false. Or you believe that the insurance DoorDash provides is all you need. That is also dangerously incorrect. The truth is, you are likely driving in a state of massive financial risk every single time you go online with the app, and you don't even know it. But that ends today. In this guide, we are going to rip the confusing mask off of DoorDash insurance. We are going to give you the clear, straightforward, no-nonsense information you need to protect yourself, your car, and your livelihood. We will break down exactly what DoorDash's policy covers, and more importantly, what it doesn't. We'll expose the giant, canyon-sized gaps in that coverage that can leave you financially ruined. We'll explain why your personal policy is a trap waiting to be sprung. And we will show you, step by step, how to get the right kind of insurance, often for just a few extra dollars a month, so you can drive with confidence, knowing you are truly protected. Look, I get it. Insurance is the last thing you want to deal with. It's complicated, it feels expensive, and it's boring. You're out here to make money, not to read 100-page policy documents. But ignoring this is like driving down the highway at 70 miles an hour with your eyes closed. You might be fine for a while, but eventually it's going to end in disaster. My promise to you is that by the end of this, you will understand this topic better than 99% of the other drivers on the road, and you'll have a clear action plan to get protected. So let's start with the most critical concept you need to understand. Your time as a DoorDash driver is not one continuous block. From an insurance perspective, it's broken down into 3 distinct phases. And the coverage you have, or more accurately, the coverage you don't have, changes dramatically with each phase. Let's call phase 1 the waiting game. This is when you've opened the Dasher app, you're online, and you're available to receive orders, but you haven't accepted one yet. You might be driving around a hot spot, or just sitting in a parking lot. Who is insuring you during this time? Is it your personal auto insurance? No. The second you go online with a commercial intent, the intent to make money, most personal policies consider that business use and can deny a claim. Okay, so is DoorDash covering you? Also no. DoorDash's insurance policy does not kick in until you have accepted a delivery request. Let that sink in. During phase 1, while you are online and waiting for an order, you are in an insurance black hole. You are in a gray area where you have effectively zero collision coverage for your own vehicle and potentially zero liability coverage for any damage you might cause. If you get into an accident during this time, even a minor fender bender, your personal insurer can deny you, and DoorDash will tell you it's not their problem because you weren't on an active delivery. You are completely on your own. This is, without a doubt, the single most dangerous and misunderstood period for any delivery driver. Now for phase 2. The pickup. You've accepted an order, and you're driving to the restaurant. The moment you tap accept, things change. Now, DoorDash's insurance policy comes into effect. This is the policy you hear about, the one that provides $1 million in liability coverage. But here's the fine print they don't exactly shout from the rooftops. First, it's what's called a contingent policy. That's a fancy word that means it only pays out after your personal insurance has denied the claim. You must file with your own insurance first, get officially denied in writing, and only then will DoorDash's policy even consider stepping in. Second, and this is the absolute key, their policy is for liability only. What does liability mean? It means it covers damage you cause to other people or other people's property. If you run a red light and smash into a new Mercedes, their liability coverage will help pay for the repairs to the Mercedes and any medical bills for its driver. But what about your car? What about your 2018 Honda Civic that's now totaled? DoorDash's insurance provides absolutely nothing for that. Zero. It does not cover physical damage, also known as collision or comprehensive coverage, for your own vehicle. So, while you're driving to the restaurant, if you get into an accident, DoorDash will help pay for the other guy's car, but you are still 100% on the hook for your own repairs. And that brings us to phase 3, the drop-off. You've picked up the food, and now you're driving from the restaurant to the customer's location. The insurance situation here is exactly the same as in phase 2. DoorDash's contingent liability policy is active. It protects you against claims from other people if you cause an accident. But again, it offers absolutely nothing, not one single penny, for damage to your own car. If someone pulls out in front of you and you can't stop, or you slide on a wet road and hit a telephone pole, the cost of fixing or replacing your vehicle is entirely your problem. So let's put it all together. Let's be crystal clear. From the moment you log into the Dasher app to the moment you complete your final delivery, DoorDash's insurance policy never covers damage to your own car. Ever. Their coverage is exclusively designed to protect them from being sued if you hurt someone else. It is not designed to protect you or your most important asset, your vehicle. This is the core of the problem. Your personal policy won't cover you because you're working, and DoorDash's policy won't cover your car at all. You're caught in the middle in a massive insurance gap. So if you're one of the millions of drivers out there relying on just one of those two policies, you are taking a financial gamble that could cost you everything. The question is, how do you close that gap? How do you get real protection that covers you in all three phases for both liability and, crucially, for your own car? That is the solution we are going to build for you, and it starts with understanding the specific types of insurance products that were created to solve this exact problem. So let's break down these solutions. Broadly speaking, you have two main paths you can take to get fully protected. The first is called a rideshare endorsement, and the second is a full-blown commercial auto policy. Think of it like this. Are you modifying your family car for a side hustle? Or are you buying a dedicated work truck? The rideshare endorsement is the modification. The commercial policy is the work truck. Let's start with the one that applies to 90% of you watching this, the rideshare endorsement. The word endorsement is just insurance speak for an add-on. It's also called a rider. It's not a separate policy. Instead, it's a specific clause that you add to your existing personal auto insurance policy. What this clause does is incredibly powerful. It essentially tells your personal policy, hey, I know you normally freak out when I use my car for business, but for the specific purpose of food delivery with an app like DoorDash, I want you to extend my coverage. It's designed to plug the exact gaps we talked about in the last video. So how does it work in practice? Let's go back to our 3 periods. During period 1, when you're online waiting for an order, your personal policy is void and DoorDash offers you nothing. This is the biggest, most common gap. A rideshare endorsement closes this gap completely. With that endorsement, your personal insurance company now recognizes you're working, and it extends your full personal liability limits to cover you during this waiting period. If you rear-end someone while looking for a good hotspot, you are covered. That massive, terrifying hole in your protection is now sealed. Now, what about periods 2 and 3, when you're on an active delivery and DoorDash's policy is supposedly active? This is where the endorsement shows its true value. Remember how DoorDash's liability coverage is contingent? That means it only kicks in after your personal insurance denies the claim. With a rideshare endorsement, your personal insurance won't deny the claim. It will act as your primary coverage, providing a seamless layer of protection. This can be a huge advantage when dealing with claims adjusters who are familiar with your policy and are on your side, rather than a third-party company that works for DoorDash. But the most critical piece of the puzzle, the part that saves people from financial ruin, is how an endorsement handles your own car. As we established, DoorDash's policy only provides collision and comprehensive coverage for your car. if you already have it on your personal policy. But if you get into an accident while dashing, your personal insurance company, without an endorsement, will deny the claim because you were using the car for business. It's a classic catch-22. They'll say, "Sorry, you were working, we're not paying." You're left with a wrecked car and no one to pay for it. A rideshare endorsement solves this. It extends your personal comprehensive and collision coverage to protect your own vehicle through all 3 periods of delivery driving. Whether you're waiting for an order, driving to the restaurant, or heading to the customer's house, if your car is damaged, your own insurance policy, the one you trust and pay for every month, will step up and cover the repairs or the total loss of your vehicle, subject to your deductible. This right here is the single biggest reason every single DoorDash driver needs to look into this. It protects your most valuable asset, your car. Think of it like a bridge. On one side of a canyon, you have your personal auto policy. On the other side, you have DoorDash's limited commercial policy. But in between, there's a huge gaping chasm. The rideshare endorsement is the steel structure that connects the two sides, creating a solid, uninterrupted road of coverage from the moment you log on to the moment you log off. And the best part? Surprisingly affordable. For most drivers, adding a rideshare endorsement to a personal policy costs anywhere from $10 to $30 a month. That's it. For the price of a few deliveries, you can buy yourself professional-grade protection and the peace of mind that comes with it. Now let's talk about the second option, the full commercial auto policy. This is the heavy-duty solution. This isn't an add-on. It's a completely separate, standalone insurance policy that replaces your personal policy entirely. You don't have personal insurance and commercial insurance on the same car. You just have the commercial policy. This type of policy is designed from the ground up for vehicles used for business. It makes no distinction between personal and business use. Whether you're driving to the grocery store, going on a road trip, or dashing for 12 hours straight, you are covered by one single robust policy. There are no periods, no gaps, no handoffs between your insurance and DoorDash's insurance. There's just one policy that covers you, period. So who is this for? A commercial policy is typically for the serious, full-time driver. If you're dashing 40, 50, or 60 hours a week, and this is your primary source of income, you are essentially operating a small business. A commercial policy reflects that. It's also for drivers who might be using a vehicle exclusively for delivery, a car that never gets used for personal errands. Or perhaps you deliver for multiple apps like DoorDash, Uber Eats, and Grubhub, and you want one single policy that covers you across all of them without any confusion. The coverage provided by a commercial policy is generally superior. It often comes with much higher liability limits, sometimes up to $1 million or more, which is the gold standard for business protection. The claims process is also streamlined. The adjusters specialize in commercial incidents, and there's never any question about whether you were working at the time of an accident. You were, and that's what the policy is for. Of course, this premium level of protection comes at a premium price. A commercial auto policy is significantly more expensive than a personal policy with a rideshare endorsement. We're not talking about an extra $20 a month. We're often talking about hundreds of dollars a month. The cost can be 2, 3, or even 4 times what you pay for personal insurance, because the insurer knows you're on the road more, in traffic more, and at a statistically higher risk of an accident. So how do you choose? It really comes down to your individual situation. Let's create a simple checklist. You should probably choose a rideshare endorsement if 1. You're a part-time driver. You dash to supplement your income, not as your main job. 2. You use the same vehicle for both dashing and your personal life. It's your daily driver. 3. Cost is a major factor, and you're looking for the most affordable, legitimate way to get covered. On the other hand, you should seriously consider a full commercial policy if 1. You are a full-time delivery driver. This is your career. 2. Your vehicle is used primarily or exclusively for business. 3. You drive for multiple delivery or rideshare platforms simultaneously. And 4. You want the absolute highest liability limits and the simplest, most comprehensive coverage available, and you're prepared to treat it as a significant cost of doing business. For the vast majority of drivers, the rideshare endorsement is the perfect middle ground, offering fantastic protection for a very reasonable cost. Now, before we move on, I have to address the elephant in the room. It's the strategy that thousands of drivers try to use, and it's the single most dangerous gamble you can take. It's the don't ask, don't tell approach. This is where you just don't tell your personal insurance company that you're a DoorDash driver, and you pray you never get into an accident. Let me be crystal clear. This is financial suicide. In the event of an accident, your insurance company will launch an investigation. They won't just take your word for it. They will pull the police report, which might mention you were on a delivery. They can subpoena data from your phone or from DoorDash itself. They will find out. And the moment they discover you were using your vehicle for commercial purposes, a clear violation of your personal policy's terms, they will do two things. First, they will deny your claim entirely, leaving you personally on the hook for all the damages, which could be tens or even hundreds of thousands of dollars. Second, they will cancel your policy, effective immediately. Not only are you left with a massive bill, but you're now uninsured and will have an incredibly difficult and expensive time getting coverage from any other company in the future. It is a catastrophic, life-altering risk that simply is not worth the money you think you're saving. So now you understand the two legitimate paths to protection: the versatile rideshare endorsement and the powerful commercial policy. You know which one is likely the right fit for you. But this leads to the most important question of all. Which insurance companies actually offer these? Who can you call right now to get this protection? And who will hang up on you the second you mention the word DoorDash? Finding a company that understands and supports gig workers is the critical next step. In the next part, we are naming names. We're going to reveal which major insurance carriers are leading the way with driver-friendly policies and which ones to avoid. And I'll give you the exact questions you need to ask any insurance agent to ensure you're getting the real deal and not a policy full of loopholes. So let's start with the good guys. The companies that have actually adapted to the gig economy instead of pretending it doesn't exist. The undisputed leader in this space, and the one I see recommended most often by veteran drivers, is Progressive. Why? Because they were one of the first to the party. They understood early on that a massive part of the workforce was going to be using their personal cars for work. They offer a specific endorsement that you can add to your personal auto policy. In most states, it's just called their rideshare endorsement, but it explicitly covers food delivery as well. The beauty of the Progressive model is its simplicity. You add the endorsement, you pay a little extra each month, and boom, your personal policy's coverage limits extend to cover you while you're dashing. It fills all the gaps. App on waiting for an order? You're covered. On the way to Chipotle? You're covered. On the way to the customer's house? You're covered. There's no confusion, no gray area. It's a clean, straightforward solution. Another major player that gets it right is State Farm. Now, State Farm is a bit different. Depending on your state, they might not even require you to buy a separate endorsement. In many states, as long as you have a State Farm personal auto policy, they consider food delivery an extension of that policy, classifying you as being in business use. This is huge. It means for many drivers, you just have to call your agent, tell them you're driving for DoorDash, they'll update your policy to business use, and you're good to go. The rate increase is often very reasonable. The key with State Farm, however, is that you must have that conversation. You have to be upfront and get it in writing from your agent that you are covered for food delivery. Their rules can vary significantly from state to state, so a quick call is non-negotiable. Don't just assume you're covered. Allstate is another solid option. They offer what's called the Ride for Hire endorsement. It's specifically designed for people who use their cars for services like DoorDash and Uber. Much like Progressive's option, it extends your personal policy's coverages to fill the gaps left by DoorDash's commercial policy. It's a comprehensive solution, and Allstate is a massive, reputable company, so you know they have the resources to handle claims properly. Geico is also on the list. They offer a hybrid policy that replaces your personal policy altogether. It's a single policy that covers your personal driving and your delivery driving. This can be a fantastic all-in-one solution that eliminates any possible confusion about which policy is active at any given time. You have one deductible, one set of liability limits, and one company to deal with no matter what happens. The cost can sometimes be higher than just adding an endorsement, but for the peace of mind, many drivers find it's worth every penny. Other honorable mentions include companies like USAA, if you're eligible, and Farmers. They both have options available in many states, but you'll need to check the specifics for your location. The bottom line with these companies is that they have acknowledged the reality of the gig economy and created real, tangible products to protect you. Now let's talk about the other side of the coin, the carriers to be cautious with. I'm not going to say these companies are bad, but their policies can be ambiguous, or they simply haven't caught up with the times, which puts you, the driver, in a very risky position. The biggest red flag is any company that doesn't offer a specific, written endorsement for rideshare or food delivery. If you call your agent and their response is a vague, "Oh, you should be fine," or "As long as you don't do it too much, it's okay," run. That is not an insurance policy. That is a verbal reassurance that will evaporate the second you need to file a claim. Think about it from their perspective. An insurance company is a business that manages risk. If they don't have a specific product for delivery driving, it means they haven't calculated the risk, and they haven't charged you a premium for that risk. So when you get into an accident while dashing, and the claims adjuster sees you were engaged in a commercial activity you weren't paying a premium for, they have every contractual right to deny your claim. They'll point to the commercial use exclusion or livery exclusion buried in the fine print of your personal policy, and you'll be toast. Not only will your claim be denied, leaving you with thousands of dollars in bills, but they will almost certainly cancel your policy for non-disclosure, or what they call material misrepresentation. Now you're in a situation where you have no car, massive bills, and you have to find a new insurance company with a policy cancellation on your record, which will make your rates skyrocket. It's a nightmare scenario that happens every single day. So who are these companies? Often they are smaller regional carriers or budget insurance companies that compete on price alone. They keep prices low by avoiding high-risk clients, and a delivery driver is, by definition, a higher risk than a standard commuter. You're on the road more in unfamiliar areas, often at night and under time pressure. That's a recipe for accidents. If an insurance quote seems too good to be true, this is often why. They're not actually quoting you for the work you do. They're quoting you for the work you told them you do, which is just personal driving. This brings us to the most critical part of this section. The exact questions you need to ask any insurance agent, whether it's for a new policy or your current one. Get a pen, open the Notes app on your phone. You need to write these down. These questions are designed to cut through the sales talk and get you a legally binding black and white answer. Question number 1. Does this policy include a specific, written endorsement that explicitly covers food delivery for a transportation network company, or TNC, like DoorDash? Use the exact phrase food delivery. Some policies cover rideshare, like Uber or Lyft, but have an exclusion for carrying property or goods. You need to make sure your policy covers delivering tacos, not people. Ask them to name the endorsement like Ride for Hire or TNC coverage. Question number 2. Can you please explain which phases of the delivery process I am covered for under this endorsement? This is where you expose the gaps. You need to know if you're covered during period 1, which is when the app is on and you're waiting for an order. This is the period where DoorDash offers zero coverage. You also need to know if you're covered during period 2 on your way to the restaurant and period 3 on your way to the customer. Your policy must cover period 1, and it should ideally cover periods 2 and 3 with your full, personal coverage limits, not just the lower state minimum liability that DoorDash's policy provides. Question number 3. If I have an accident and file a claim while I am actively working for DoorDash, is there any risk that my entire policy will be canceled or non-renewed as a result? This question gets to the heart of your biggest fear. You need an unequivocal no. The entire point of buying the proper coverage is to be able to use it without being punished for it. A legitimate, driver-friendly policy will not penalize you for using the very coverage you're paying for. Question number 4, and this is the ultimate test. Can you please email me a copy of my policy declarations page, along with the specific endorsement form or rider that states this coverage in writing? Talk is cheap. An agent can tell you anything on the phone, but they can't fake a legal document. You need physical or digital proof. If they hesitate, if they make excuses, if they say it's just noted in our system, that's a massive red flag. You want to see the words with your own eyes. You're looking for a form with a title like Transportation Network Company Driver Coverage, or something similar. Read it. Make sure it doesn't have any weird exclusions. And finally, question number 5. What are my coverage limits with this endorsement, and how do they interact with DoorDash's insurance? Do my higher personal limits for collision and comprehensive apply when I'm dashing? This confirms that you're not just getting liability coverage. You need to know that if you total your own car, your insurance will pay to fix or replace it. DoorDash's policy will never cover damage to your car. Only your own policy with the right endorsement will do that. You need to confirm that your collision and comprehensive coverage, and the deductibles you chose, are in full effect the entire time the app is on. Arming yourself with these 5 questions transforms you from a vulnerable customer into an informed consumer. You're no longer relying on an agent's vague promises. You're demanding specific contractual proof. You're taking control of your own financial security. Now that you're armed with the right questions and know which companies to look at, you're probably wondering, how much is this all going to cost? Is this special coverage going to break the bank? In the next part, we're going to break down the real costs. I'll show you average price increases, state-by-state variations, and the secret trick to getting the best possible rate. A trick that most agents won't even tell you about. So what is this big secret? Before I pull back the curtain on the single most effective way to lower your insurance bill, we have to address the elephant in the room. The number that's probably been bouncing around in your head since you started watching this series. How much is this actually going to cost me? It's the million-dollar question, or hopefully, for your sake, the $20 question. Let's be brutally honest. If you call your insurance company and say the magic words, "I'm a DoorDash driver," your premium is going to go up. There is no universe where you tell them you're adding commercial activity to your personal vehicle, and they say, "Great, we'll lower your bill." That's just not how risk works. But the increase doesn't have to be a wallet-shattering catastrophe. The fear of the unknown is what stops most drivers from making that call. They imagine a bill that doubles or triples, making dashing unprofitable. The truth is, the cost is a moving target. It depends on a dozen factors, some you can control and some you can't. Think of it like this. Asking, "How much does rideshare insurance cost?" is like asking, "How much does a car cost?" Well, are you buying a 1998 Honda Civic or a brand new Lamborghini? The answer is, it depends. Your final price is a unique cocktail mixed specifically for you. The ingredients: your age, your driving record, the car you drive, where you live, your credit score in many states, and the coverage limits you choose. A 45-year-old driver with a perfect record in a Toyota Camry living in rural Wyoming is going to have a profoundly different quote than a 22-year-old with a couple of speeding tickets in a Dodge Charger living in downtown Miami. So let's cut through the noise. Based on data from thousands of drivers across the country, the typical increase for adding a rideshare or food delivery endorsement to a personal auto policy ranges from as little as $8 a month to as much as $150 a month. Whoa, that's a massive range, right? An extra $150 a month is a car payment, but an extra $8 or $15, that's 2 cups of coffee. Why the huge difference? It comes down to 2 main things: the insurance carrier and your location. Some companies like Progressive or State Farm have been in the gig work insurance game for a while. They have tons of data, and their pricing is often more competitive. Other companies might be newer to it, see it as a higher risk, and price their endorsement accordingly to discourage all but the most desperate drivers. But the biggest factor by far is your state. Insurance is regulated at the state level, not the federal level, which means we have 50 different laboratories of risk. This creates a massive variance in what you'll pay. Let's break this down into 3 general tiers. First, you have the high-cost states. Think Florida, Louisiana, Michigan, New York, and California. Why are they so expensive? It's a perfect storm of factors. You have higher population density, which means more cars on the road and a higher likelihood of accidents. You have more extreme weather events like hurricanes and snowstorms. And critically, you have a more, let's call it, litigious environment. These states often have legal systems that lead to higher claim payouts, more lawsuits, and unfortunately, more fraud. In these states, you can expect to be on the higher end of that range, potentially looking at an increase of $50 to $150 per month. It's a tough pill to swallow, but operating without it in these states is like playing Russian roulette with your entire financial future. Next, you have the medium-cost states. This is the bulk of the country. States like Texas, Ohio, Pennsylvania, Illinois, and Georgia. Here, the population is a mix of dense urban centers and sprawling suburbs. The legal environments are more moderate. In these states, a rideshare endorsement will likely add somewhere between $20 and $60 to your monthly premium. This is the most common range for the average driver. It's a noticeable expense for sure, but it's a manageable business cost when you break it down. Finally, you have the low-cost states. We're talking about places like Idaho, Wyoming, Maine, Iowa, and the Dakotas. These states typically have lower population density, fewer major metropolitan areas, and more straightforward insurance laws. The overall risk is just lower. In these states, it's not uncommon to see an increase of only $8 to $25 a month. For these drivers, getting the proper coverage is an absolute no-brainer. The peace of mind is worth far more than the cost of a weekly fast food meal. Now, hearing these numbers might still cause a little bit of sticker shock. An extra $60 a month is an extra $60. But let's reframe this. You are not a regular driver anymore. You are a small business owner. And this insurance is a cost of doing business just like gas and car maintenance. Let's do some dasher math. Let's take a mid-range number, say your insurance goes up by $50 a month. If you complete just 10 deliveries a day, 5 days a week, that's roughly 200 deliveries a month. $50 divided by 200 deliveries is 25 cents. You are paying a quarter per delivery to transfer a $100,000 risk off of your shoulders and onto a multi-billion-dollar insurance company. When you think of it that way, it's the best 25 cents you will ever spend. It's the difference between a minor inconvenience and a life-altering financial catastrophe. Okay, so you know the ballpark cost. You know it varies by state. You've reframed it as a tiny per-delivery business expense. Now it's time for the secret. The trick I mentioned that most insurance agents, specifically the ones you see on TV, won't tell you about. The secret isn't a magic word or a secret discount code. It's understanding how the insurance industry is actually structured. There are two fundamental types of insurance agents you can buy from: a captive agent and an independent agent. And choosing the right one is the single most important decision you will make in this process. A captive agent works for one company and one company only. Think of the agent you see in commercials, the one who works for State Farm or Allstate or Farmers. They are good people and they can be very helpful, but they are fundamentally limited. They can only sell you products from their one company's menu. If their company's rideshare endorsement is expensive in your state, or if their underwriting rules are strict for delivery drivers, they can't do anything about it. Their only tool is the one hammer their company gave them. If you're a nail, great. But if you're a screw, you're out of luck. Now, an independent agent is different. They are like an insurance broker. They don't work for any single insurance company. Instead, they have contracts with dozens of different carriers, companies like Progressive, Travelers, Safeco, and many others you've never even heard of. Their loyalty is to you, the customer, not to a big corporation. When you go to an independent agent and say, "I'm a DoorDash driver in Ohio with a 2019 Honda Accord," they don't just pull up one quote. They plug your information into a system that shops your policy across 10, 20, even 30 different insurance companies simultaneously. They can instantly see which company offers the most competitive rate for your specific situation. Company A might be great for homeowners but terrible for gig workers. Company B might be super expensive for team drivers but have an amazing, affordable rideshare endorsement. A captive agent would never know this. An independent agent sees it all laid out in front of them. They can compare not just the prices, but the specific terms of each company's delivery endorsement. They can find the hidden gem, the carrier that actually wants your business and has priced their product to attract it. This is the trick. Don't just call the number on your current insurance card. That's playing their game. You need to change the game. By working with an independent agent, you turn the tables. You make the insurance companies compete for your business, not the other way around. This is how you find that $15 a month policy instead of the $75 a month one. It's the difference between feeling trapped and feeling empowered. So now you have the secret weapon. But just finding an independent agent isn't enough. You need to know what to say, what questions to ask, and what red flags to watch out for to make sure you're not just getting a cheap policy but the right policy. Because a cheap policy that doesn't cover you when you need it is the most expensive mistake of all. And in the next part, I'm going to give you the exact script, the 5 critical questions you must ask any agent before you give them a single dollar. These questions will instantly reveal whether they know what they're talking about or if you need to hang up and find someone else. Alright, get a pen and paper or open up the Notes app on your phone, because you are about to become an insurance agent's worst nightmare, or their favorite, most informed client. This is the ultimate test. Question number 1. It's the gatekeeper. The second these words leave your mouth, you'll know if you're talking to a pro or a pretender. You simply ask, "I'm a delivery driver for DoorDash. Can you confirm if my current personal auto policy provides any coverage at all while my app is on and I'm working?" Now listen very, very carefully to their answer. If they hesitate, if they say, "I think so," or "It should be fine," that's a massive red flag. A truly knowledgeable agent will have an instant, definitive answer. The correct answer is an unequivocal no. They should immediately explain that a standard personal auto policy contains what's known as a business use exclusion, or a livery exclusion. This clause specifically voids your coverage the moment you begin using your vehicle for commercial purposes, which includes delivering food for profit. If the agent doesn't say this, if they waffle, or worse, if they say, "Oh yeah, you're covered," hang up the phone. Seriously. Do not pass go, do not give them your social security number. You are speaking to someone who is either dangerously uninformed or willing to mislead you, and both will leave you financially ruined in an accident. A great agent will use this as a teaching moment, explaining the gap and setting the stage for the solution. Okay, let's say they pass round 1. They correctly identified the problem. Now you hit them with question number 2, which tests the depth of their knowledge. You say, okay, I understand my personal policy is no good. So, when we talk about getting the right coverage, can you explain to me how it works with the different phases of a delivery? Specifically, what's my coverage situation when I'm online waiting for an order, versus when I'm driving to the restaurant, and then from the restaurant to the customer's house? This is the expert level question. You're asking about what the industry calls period 1, period 2, and period 3. A top-tier agent won't even flinch. They'll say something like, great question. Let's break it down. Period 1 is when your app is on, but you haven't accepted a delivery request yet. This is a notorious gray area where DoorDash's insurance may not apply, leaving you exposed. Period 2 is from when you accept an order until you pick up the food, and period 3 is from the restaurant to the customer. During periods 2 and 3, DoorDash provides contingent liability coverage, but it's crucial to understand it's secondary to your own insurance and has high deductibles for collision. If your agent can't break this down, if they just say you're covered once you get an order, they don't understand the nuances of the gig economy. They don't grasp that the biggest risk for a driver is often in that period 1 gap, when you're driving around waiting for a ping. You need an agent who understands these phases inside and out, because the policy they sell you must be designed to fill those specific gaps. Anything less is just guesswork. Assuming they nail question 2, it's time for question 3. This one cuts through the jargon and the common costly mistakes. You ask, what is the exact name of the product you're recommending for me? Is it a rideshare endorsement? Or is it something else? And can you confirm it specifically covers food delivery, not just carrying passengers? This is a precision strike. Why? Because many insurance companies jumped on the Uber and Lyft wave by offering rideshare endorsements. But a huge number of these endorsements explicitly exclude delivery services. They were written for transportation network companies or TNCs that move people, not property like food. An amateur agent will hear gig work and just slap a generic rideshare endorsement on your policy, thinking they've solved the problem. You could pay for this endorsement for years, only to find out after an accident that your pizza delivery wasn't covered. The agent you want to work with will respond with confidence. They'll say, we need to add a specific endorsement for delivery services. At our company, it's called insert specific name here, or we might need to move you to a commercial policy. Our rideshare coverage does not apply to food delivery, so we have to be very careful to add the correct protection. They should be able to name the product and assure you that it explicitly includes the delivery of goods or food. If they can't make that distinction, or if they try to convince you that a generic rideshare policy is good enough, they are putting you at risk. Now for question number 4. This one is about the real-world consequences and the interaction between policies. You lean in and ask, let's play out a scenario. If I have the coverage you're recommending and I get into an accident while on a delivery, what does the claims process look like? Do I call you first? Do I call DoorDash? And will my claim with DoorDash's insurance company affect my rates or my standing with you? This is a critical systems check question. You're testing if they understand how the different insurance layers are supposed to work together. A bad agent will give you a vague answer. Oh, just call us and we'll handle it. That's not good enough. A professional will walk you through the process. They'll explain that you should notify both them and DoorDash. They'll clarify that DoorDash's insurance is typically contingent, meaning it only kicks in after your own policy denies the claim or if the damages exceed your policy limits. Most importantly, they should be transparent about how claims work. They should explain that yes, any accident, whether you're on the clock or not, can impact your future rates. But they should also reassure you that because you have the correct policy, the claim will be processed legitimately. You won't be at risk of being dropped for non-disclosure or fraud, which is what would happen if you had an accident while hiding your gig work. This question isn't just about procedure. It's about testing their honesty regarding the messy reality of an actual claim. Finally, we arrive at the 5th and final question, the ultimate truth serum. After they've answered everything else, you look them in the eye, or you say with a firm tone over the phone, I appreciate all this information. It's very helpful. Before I agree to anything, can you please send me a copy of the actual policy language or the endorsement form that explicitly states food delivery is a covered activity? I need to see the exact wording in black and white. This is the checkmate move. Talk is cheap. Promises from an agent are worthless if they aren't backed up by the legally binding contract you're about to sign. A confident, honest agent will have zero problem with this request. They'll say, absolutely. I can email you the specimen policy jacket for endorsement XYZ right now. You'll want to look at Section C, Paragraph 4, where it defines covered business use. They will be happy to prove their claims. An agent who is bluffing, who isn't 100% sure, or who is trying to push you into a policy that doesn't quite fit will squirm. They'll get defensive. They'll say things like, oh, it's all standard, you don't need to read that, or it's very complicated legal language, or just trust me, you're covered. Do not trust them. If they cannot or will not provide written proof from the underwriter, the conversation is over. You thank them for their time and you move on. Armed with these 5 questions, you are no longer a passive customer. You are an informed buyer in a position of power. You can now surgically dissect any insurance proposal and expose any weaknesses or deceptions in minutes. You can protect yourself, your car, and your livelihood from the single biggest financial threat a DoorDash driver faces. But now that you know how to find the right agent and the right policy, a new massive question emerges. What does it actually cost? And why do some drivers get quoted a reasonable $20 or $30 a month, while others are hit with astronomical bills for hundreds? It often seems random, but it's not. There are hidden factors in your driver profile that can send your rates into the stratosphere. And in the next part, we're going to expose them. I'm going to show you the 3 silent rate killers that most drivers don't even know about, and give you the strategy to neutralize them before you even ask for a quote. Alright, let's get into it. The first silent rate killer is what I call the category error. This is where an insurance agent with the best of intentions puts you in the wrong box. And that box costs a fortune. Here's how it happens. You call up for a quote and you say, hi, I'm a DoorDash driver, I need insurance. The agent hears the word delivery, and their brain immediately pulls up a file folder labeled commercial auto. They start thinking about pizza delivery guys in company cars, Amazon delivery vans, florists, couriers, businesses that use vehicles all day, every day as their primary tool. They see you as a full-time, professional commercial driver. So, they start quoting you a full-blown commercial auto policy. These policies are designed for vehicles with company logos on the side, that are on the road 8 to 10 hours a day, racking up 50,000 miles a year. The premiums for these policies are astronomical. We're talking several hundred, even over $1,000 a month. You get the quote, your jaw hits the floor, and you hang up thinking that insurance for DoorDash is simply unaffordable. But you were never in the right category to begin with. Here's the strategy to neutralize this. You have to control the language. You must reframe the conversation from the very first sentence. When you call for a quote, you do not say, I'm a delivery driver. That's the trigger word. Instead, you use this precise phrasing. Hi, I'm looking to update my personal auto policy. I use my personal vehicle to occasionally earn extra income through a transportation network company, or TNC, like DoorDash. Let's break down why that sentence is pure gold. First, you start with personal auto policy. This immediately anchors the conversation in the world of personal insurance, not commercial. Second, you use the phrase occasionally earn extra income. This frames it as a side gig, a part-time hustle, not a full-time commercial enterprise. It paints a picture of lower risk. Finally, and most importantly, you use the industry term, Transportation Network Company, or TNC. This is the secret code. It tells a knowledgeable agent that you're not a pizza guy. It tells them you're a modern gig worker who needs a specific modern solution. That solution is not a commercial policy. It's a rideshare endorsement, or a TNC endorsement, added to your personal policy. By using their language, you force them to find the right product, which is almost always dramatically cheaper than the commercial policy they might have defaulted to. You've just sidestepped the most expensive trap in the game. The second silent rate killer is what I call the mileage mirage. This is all about how you report the miles you drive. Most drivers do one of 2 things, and both are terrible. They either pull a number out of thin air, a wild guess, or they meticulously track their total miles and report a single huge scary number to the insurance company. They'll say, yeah, I drive about 30,000 miles a year. To an insurance underwriter, that number is a massive red flag. In their world, more miles equals more time on the road, which equals more risk, which equals a higher premium. End of story. But that's a dangerously incomplete picture. The strategy here is not to lie, but to add context and break the number down. The key is understanding that not all miles are created equal. Your personal miles driving to the grocery store or on a road trip are a different risk profile than your DoorDash miles, which are often lower speed, stop-and-go trips in a defined local area. So, first, you absolutely must be tracking your mileage. Use an app like Stride, Everlance, or Hurdler. This isn't just for your taxes. It's your secret weapon for getting a fair insurance quote. Once you have accurate data, you neutralize the mileage mirage by presenting it intelligently. Instead of giving them one big number, you dissect it for them. You'll say something like this: my total estimated annual mileage is 25,000 miles. I want to be transparent about how that breaks down. About 15,000 of that is my standard personal commuting and family use. The other 10,000 miles is what I anticipate driving while logged into the DoorDash app. Do you see the power in that? You've just transformed from a high-risk driver with a scary number into a responsible, data-driven professional. You've shown them that 2/3 of your driving is just normal, everyday stuff that they already know how to insure. The scary part, the delivery driving, is now a much smaller, more manageable number. It gives the underwriter a much more accurate and favorable picture of the actual risk they're taking on. You can even frame it as a percentage. About 60% of my driving is personal, and 40% is for my side gig with DoorDash. This reframes the entire risk assessment. It's the same total mileage, but presented in a way that separates the perceived high-risk activity from your normal low-risk life. It's the difference between telling a doctor I feel sick and telling them, I have a sharp pain in my lower left abdomen that started this morning. Specificity removes fear, and for an insurance company, less fear means a lower price for you. Now for the third and most insidious silent rate killer, the coverage gap panic. This happens when you're talking to an agent who isn't an expert in gig economy insurance. They might have heard of Uber or DoorDash, but they don't truly understand how the 3 periods of coverage work. So when you mention DoorDash, their brain goes into panic mode. All they hear is uninsured risk. They start imagining you getting into an accident while the app is on but before you have a delivery, and they see a giant, messy, expensive lawsuit with no one to pay for it. Their professional instinct is to run away from that risk. So they'll do one of two things. They'll either flat out decline to offer you a policy saying it's too complicated, or they'll quote you an absolutely insane premium. That high price isn't based on your actual risk. It's a go-away price. It's the agent protecting themselves and their company from a risk they don't understand. They're jacking up the price to cover their own uncertainty. The neutralization strategy here is to eliminate their uncertainty. You have to become the expert in the room and educate them. You need to walk them through it and show them that you've already solved the puzzle. This calms their fears and allows them to quote you on the actual specific risk, not their imagined worst-case scenario. You do this with a prepared script. When the conversation turns to the details of your DoorDash work, you confidently say this: I've done my research on how TNC insurance works, and I know exactly what I need. I'm looking for a policy that includes a rideshare endorsement. My primary concern is making sure I have coverage for period 1, which is the time I'm logged into the app and waiting for a delivery request. I understand that once I'm on my way to the restaurant and to the customer. That's periods 2 and 3. DoorDash's commercial policy provides contingent liability coverage. So, I just need to make sure my own policy properly fills that gap in period 1. That single paragraph is a silver bullet. It instantly flips the script. You're no longer a confused customer asking for help. You are now an informed client dictating the precise solution you require. You've shown them you understand the specific periods of coverage. You've identified the exact gap, period 1, that needs to be filled. And you've demonstrated that you know where the corporate insurance kicks in, which removes their fear of having to pay for a catastrophic accident during a delivery. You've taken away all their uncertainty. You've made their job easy. They don't have to guess what you need or quote you a massive policy to cover every possibility. They can now go and find the one specific product, the rideshare endorsement, that does exactly what you've asked. You've calmed the panic, and in doing so, you've prevented them from quoting you a panic-driven price. These 3 strategies, correcting the category error, contextualizing the mileage mirage, and calming the coverage gap panic, are your shield. They prevent you from being miscategorized, misjudged, and mispriced before the quoting process even truly begins. You are now armed with the language and the logic to control the conversation and guide the agent to the most accurate and affordable policy. Now that you know how to disarm these traps, you're ready to actually go shopping. But walking into the insurance marketplace unprepared is like walking into a lion's den with a stake tied around your neck. In the next part, I'm going to give you the ultimate 5-step battle plan for getting quotes, comparing apples to apples, and making the insurance companies fight for your business. Alright, let's get into it. This is your 5-step battle plan. This isn't just about getting a quote. It's about executing a strategic operation to secure the best possible protection at the lowest possible price. Forget being a passive consumer. Today, you become the commander of your financial security. Step 1 is reconnaissance and intelligence gathering. You would never launch an attack without knowing the terrain and having your equipment ready. The same goes for insurance. Before you make a single phone call or click a single link, you need to assemble your dossier. This is non-negotiable. Walking into this unprepared is how you get taken advantage of. First, you need your vehicle's information. I'm talking about the year, make, model, and most importantly, the VIN, the vehicle identification number. It's on your registration, your current insurance card, and usually on a little plate on your dashboard visible through the windshield. The VIN is your car's fingerprint. It tells the insurance company its entire history. Next, your personal intel. Get your driver's license number. You also need an accurate estimate of your annual mileage. And I mean all your mileage, personal driving, commuting, and your DoorDash miles. Be honest here. If you lowball it to save a few bucks and then get in an accident 200 miles from home after driving 25,000 miles in 6 months, they have every right to investigate and deny your claim for misrepresentation. It's not worth it. So do the math. If you dash 20 hours a week and average 15 miles an hour, that's 300 miles a week or over 15,000 miles a year just for work. Add your personal driving, and you could easily be in the 25,000 to 30,000 mile range. Know this number. Finally, gather your driving history. This means any accidents or tickets from the last 3 to 5 years. Don't hide them. They're going to run your record anyway. Knowing your own history allows you to own the conversation and ensure their information is accurate. Having all of this data printed out or in a single document on your computer turns you from a fumbling caller into a prepared professional. This dossier is your ammunition. Now it's time to open the first front. Step 2. Deploy the independent agent. Think of an independent agent as your specialist operative, a mercenary who works for you, not for one single insurance company. They have contracts with multiple carriers, sometimes a dozen or more. Their job is to take your dossier and shop it around to all of them, finding you the best options. This saves you an enormous amount of time. Instead of making 10 calls, you make 1. But not all agents are created equal. You need to vet your operative. When you call, your first question should be, do you have experience insuring food delivery drivers for services like DoorDash? If they hesitate or sound confused, thank them for their time and hang up. You need a specialist. Your second question. Which of your carriers offer a specific rideshare or delivery endorsement? This is the key. You want them to name names. This shows they understand the unique product you need. The advantage of a good independent agent is that they know the market. They know which company is competitive for your specific profile in your specific state. They can be an incredible ally, but they don't represent everyone. They typically don't have access to the direct writers like Geico or Progressive, or the captive companies like State Farm or Allstate, who have their own agents. And that brings us to our next move. Step 3. Launch the direct assault. While your independent agent is fighting for you on one front, you are going to open a second front yourself. This is a pincer movement designed to ensure no stone is left unturned. You are going to get quotes directly from the companies your agent doesn't represent. Go online or call the big names directly. Geico, Progressive, State Farm, Allstate, a few others. When you speak to them, you use the same professional approach. You have your dossier ready. You state clearly, I am a DoorDash driver, and I need a policy that includes a commercial use or food delivery endorsement. Can you provide me with a quote for that specific coverage? By doing this, you are creating competition. You'll have the quotes from your independent agents' carriers, and now you'll have quotes from the direct carriers. You are building a complete intelligence picture of the entire market. This prevents you from getting locked into a single agent's limited options and puts the power squarely in your hands. Now you'll have a stack of offers. But a stack of offers is just meaningless paper until you learn how to decode it. Step 4. The apples to apples takedown. This is without a doubt the most critical step in the entire process. It's where most people get it wrong. They just scan for the lowest number at the bottom of the page and sign up. That is a catastrophic mistake. An insurance quote is not a single number. It's a complex package of protections, and you have to compare them line by line. You need to create a simple spreadsheet or just a piece of paper with columns. For each quote, you're going to analyze 3 critical areas. First, the core liability limits. That's your bodily injury and property damage coverage, written as 3 numbers, like 50/100/25. Make sure every quote you are comparing has the exact same liability limits. Comparing a state minimum policy to a policy with 100/300/50 limits is like comparing a bicycle to a bullet train. They're not in the same universe. Decide on the limits you're comfortable with and disqualify any quote that doesn't match. Second, the deductible dilemma. Look at the deductibles for comprehensive and collision coverage. This is the amount you pay out of pocket before the insurance company pays a dime. One quote might look $20 cheaper per month, but it has a $2,000 deductible, while the other has a $500 deductible. Is saving $240 a year worth risking an extra $1,500 out-of-pocket expense if you have an accident? For most dashers, the answer is a hard no. Standardize the deductibles across the quotes you're seriously considering. Third, and this is the big one for us, the endorsement fine print. The quote must explicitly list the rideshare or food delivery endorsement. Get a copy of the policy jacket or the endorsement language itself. Does it cover you while you're on your way to the restaurant? Does it cover you while you're waiting for the food? Does it cover you all the way to the customer's door? Ask the agent to confirm in writing via email that the policy and endorsement they are quoting you provides coverage for food delivery activities with DoorDash. An email is a written record. A phone call is just air. Some policies have weird exclusions, like they cover rideshare but not delivery, or they only cover you for a certain number of hours per week. You must verify this. The cheapest quote in the world is worthless if it doesn't actually cover you when you need it most. Once you've done this, once you've truly compared apples to apples on liability, deductibles, and the specific delivery coverage, you will have identified the 1 or 2 truly best offers. But we're not done yet. It's time to make them fight for it. Step 5, the final gambit. You've done the work. You've gathered the intel, you've probed the market from 2 directions, and you've decoded the offers. You have identified the best legitimate quote. Let's say it's from Company A for $150 a month, but your second best quote is from Company B for $165 a month. And let's say you'd actually prefer to be with Company B for some reason. Maybe they have a better reputation or a local agent you like. Now, you execute the final play. You call the agent for Company B and you say this calmly and respectfully. Hi, I'm ready to make a decision on my insurance. I really appreciate you putting this quote together for me, and I'd prefer to go with your company. However, I have a written apples-to-apples quote from Company A for the exact same coverage, same liability limits, same deductibles, same delivery endorsement, for $150 a month. My only hesitation is the price difference. Is there anything you can do to match that price or get closer to it? And then you are silent. You let them work. What you've just done is given them a concrete target and a clear reason to fight for your business. You're not just asking for a random discount. You're showing them you're a savvy shopper who is one signature away from going to their direct competitor. Insurance is a cutthroat industry. They want your business. Sometimes they'll say no, that the price is the price. But you would be absolutely shocked how often they'll come back and say, let me see if there are any other discounts we missed. Or, you know what, we can re-rate that and get it down to $155. They might not match it exactly, but they might just close the gap enough to win you over. You have nothing to lose and potentially hundreds of dollars a year to gain. This 5-step plan, recon, agent, direct assault, decode, and gambit, transforms you from a price taker into a price maker. Puts you in total control of the entire process. You will understand your coverage, you will know you're not overpaying, and you will have the peace of mind that comes from being properly and thoroughly protected while you're out there on the road grinding it out. You've built your fortress. But even the strongest fortress can be brought down from the inside by simple, avoidable mistakes. And there are some catastrophic errors that even smart drivers make that can nullify their policy in an instant. We need to talk about those. Now, these aren't just minor slip-ups or clerical errors. These are the tripwires, the hidden landmines in your policy documents that can detonate your entire financial life. And the single most common, the most devastating mistake of all, is the one that happens before you even start your first delivery. It's the original sin of gig work insurance. Misrepresentation. That's the industry term. For the rest of us, it's called lying. Or more subtly, lying by omission. It starts with a simple seductive thought. I'll just try DoorDashing for a few weeks. If I like it, then I'll tell my insurance company. Why would I pay a higher premium if I'm not even sure I'm going to stick with it? Sounds logical. It sounds prudent, but it is the single most dangerous gamble you can take. Because in the world of insurance, there is no such thing as a small lie. Let's imagine a driver. We'll call him David. David is smart. He has a good personal auto policy with a major carrier. He's never even had a speeding ticket. To make some extra cash for a vacation, he signs up for DoorDash. He reads a few forums, sees people talking about their rates going up, and makes a calculated decision. I'm a safe driver. I'll just keep this to myself. What they don't know won't hurt them. For 2 months, everything is perfect. David is a great dasher, great ratings, making good money. He's just a few $100s away from his vacation goal. Then one Tuesday afternoon, on his way to drop off a Chipotle bowl, it happens. A driver runs a stop sign and T-bones him. It's not a horrific crash, but it's bad enough. The airbags deploy, the front end of his car is crumpled. Most importantly, nobody is seriously hurt, thank God. The other driver is clearly at fault and admits it to the police officer who arrives on scene. David thinks, okay, this is a nightmare, but at least it's not my fault. Their insurance will cover everything. He files the police report. He calls his insurance company to start the claim process. And that's when the fortress begins to crumble from the inside. The claims adjuster from his insurance company, a perfectly friendly person, starts asking routine questions. So, David, can you tell me where you were going at the time of the accident? David's heart starts pounding. He has 2 choices and both lead off a cliff. Pathe, he lies. Oh, I was just heading home from a friend's house. The adjuster says, okay, no problem. But it is a problem. Because insurance companies are not in the business of trust. They are in the business of verification. They will subpoena his phone records to verify his location and cell usage. They will talk to the other driver, who might mention the DoorDash hot bag on the passenger seat. They'll talk to the police officer whose report might note the smell of fresh guacamole in the car. When they discover he was working, they won't just deny his claim. They will cancel his policy, effective from the date he started dashing, and they will flag him for insurance fraud. Insurance fraud is not a slap on the wrist. It's a felony in most states. It can mean fines and it can mean jail time. And it guarantees that for years to come, getting affordable insurance from any reputable company will be next to impossible. Path B, he tells the truth. I was on a delivery for DoorDash. The adjuster's friendly tone doesn't change. Oh, okay. Thank you for letting me know, David. I appreciate your honesty. But a few days later, he gets a certified letter in the mail. It's a denial of claim. The letter explains that his personal policy explicitly excludes coverage for any commercial or delivery-related activities. Because he was using his vehicle for business, his policy was void at the moment of the crash. And to add insult to injury, they are canceling his policy at the end of the term for failure to disclose his commercial activities. David is now facing thousands, maybe tens of thousands of dollars in repairs to his car, with zero help from his own insurance. And remember, the other driver was at fault, right? So their insurance has to pay. Wrong. The other driver's insurance company now has to deal with DoorDash's insurance, a complex commercial carrier. The process will drag on for months, maybe years. In the meantime, David has a wrecked car he can't drive, no way to earn money dashing, and a policy cancellation on his record. All because he wanted to wait and see before telling his insurer. This is the #1 mistake. It is a catastrophic, unforced error. But let's say you're smarter than that. You listened to the previous parts of this guide. You called your insurer, you were honest, and you added the rideshare or delivery endorsement to your policy. You're paying a little extra, but you have peace of mind. You're completely covered, right? Not so fast. This brings us to mistake number 2. Misunderstanding your endorsement. Not all endorsements are created equal. In fact, some of them are so specific they create dangerous new gaps in your coverage that you didn't even know existed. Many basic endorsements only cover you during what the industry calls period 1. That's the time when you have the app on, but you haven't accepted an order yet. You're just waiting for a ping. The moment you accept an order and start driving to the restaurant, you've entered period 2. DoorDash's limited coverage kicks in here, but your personal endorsement might have just switched off. Imagine you get into an accident on your way to the restaurant. You call your insurance company, confident in your endorsement. They look at your claim and say, sorry, our endorsement only covers you while you're waiting for a request. Since you were en route to a pickup, you're not covered by us. Then you turn to DoorDash's insurance, and they might argue their coverage is contingent and secondary. You are now trapped in a vicious finger-pointing match between 2 giant insurance companies, And you're the one stuck in the middle with the bill. You did the right thing, but you failed to read the fine print. You have to ask your agent explicitly, does this endorsement cover me while I'm driving to the restaurant and while I'm driving to the customer's house? If the answer isn't a clear yes to both, you are not fully protected. Now for the third mistake, one that's a little more obscure but just as deadly. It's called the permissive use pitfall. Most personal auto policies have a clause that allows you to let a friend or family member borrow your car occasionally. Your insurance still covers them. But that permissive use clause is instantly vaporized the second the car is used for business. Let's say your brother's car is in the shop and you let him borrow yours for the day. To thank you, he decides to do a few DoorDash orders to make some gas money. He gets into an accident. Who pays? DoorDash won't, because your brother isn't the registered dasher on the account. Your personal insurance company won't, because their permissive use clause does not extend to commercial activity. Your rideshare endorsement won't apply because it's tied to you, the named insured, performing the delivery, not your brother. The result is an absolute black hole of coverage. You, as the vehicle owner, are now personally on the hook for all the damages both to your car and to the other parties. Letting someone else dash in your car, even for an hour, is like handing them a financial grenade and pulling the pin. Finally, there's a simple, almost administrative mistake that can cost you everything: the vehicle mismatch. You have your Toyota Camry properly insured with a full delivery endorsement. It's perfect, but today the Camry has a flat tire, so you take your spouse's SUV to do your deliveries. You forget to update the vehicle information in the DoorDash app, and critically, you haven't listed the SUV on your commercial use policy. If you get into an accident in that SUV while dashing, you have zero coverage. Period. The denial is instant and non-negotiable. The policy is for a specific vehicle, identified by its VIN. If the VIN of the wrecked car doesn't match the VIN on the policy covering commercial use, it's game over. These four mistakes: misrepresentation, misunderstanding your endorsement, permissive use, and vehicle mismatch, are the silent killers of a driver's financial security. They aren't born from malice, but from misunderstanding the brutal, unforgiving logic of the insurance world. They see black and white, covered or not covered. Your good intentions mean nothing to them. So we've built the fortress and identified the internal traitors that can bring it down. But what happens when the worst actually happens? What are the exact step-by-step actions you must take the second you hear that crunch of metal? Because what you do in the first 5 minutes after a crash can define the next 5 years of your financial life. That's what we're breaking down next. The first thing you feel is the jolt. A violent, sickening shudder that rips through the car. Then the sound, the unmistakable, gut-wrenching scream of twisting metal and shattering glass. Your heart hammers against your ribs, a frantic drumbeat in the sudden, deafening silence that follows. Your mind is a blur of panic and adrenaline. This is the moment where everything can go right or horribly, financially, catastrophically wrong. Let's break this down into a precise military-grade action plan. Forget panic. Follow these steps. Step 1: secure the scene. Before you even think about insurance, think about survival. Are you okay? Are your passengers? Check yourself for injuries. Can you move your arms and legs? Is there any pain? Next, look at your surroundings. If the cars are in a dangerous spot like the middle of a highway, and they are drivable, the absolute priority is to move to the shoulder or a nearby safe location. If you can't move the cars, turn on your hazard lights immediately. This isn't just a suggestion. It's a beacon to prevent a secondary, more devastating collision. The first 60 seconds are about preventing further harm. Health and safety trump everything else. Step 2: call 911. I don't care if it's a tiny fender bender. I don't care if the other driver says, "Hey, let's just handle this between ourselves." I don't care if you're in a rush to complete a delivery. You call 911. Period. Non-negotiable. Here's why: you need a police report. A police report is the single most powerful document in the entire insurance claim process. It is an objective, third-party account of the incident. It establishes the time, the date, the location, the conditions, and often an initial assessment of fault by a trained officer. Without a police report, your claim becomes a messy, he said, she said, battle where the insurance companies have to piece together two conflicting stories. The police report is the bedrock, the foundation upon which your entire claim is built. Trying to build a claim without one is like trying to build a skyscraper on quicksand. Don't do it. When you call, be calm and clear. State your location, that you've been in an accident, and whether there are any injuries. Step 3: document everything. While you wait for the police, you become a detective. Your smartphone is now the most important tool you own. Do not rely on your memory. Adrenaline makes memory notoriously unreliable. Start taking pictures. And I don't mean 1 or 2 snapshots. I mean dozens. Take wide shots of the entire scene, showing the position of the cars, traffic signs, and skid marks. Take medium shots of the damage to both vehicles from every conceivable angle. Then get close-ups. Document every single scratch, dent, and crack. Photograph the other car's license plate. This is your evidence. Next, you exchange information with the other driver. Be polite, be calm, but be methodical. You need their full name, address, and phone number. You need their driver's license number. And critically, you need their insurance information. The company name, the policy number, and the phone number on their insurance card. Take a picture of their driver's license and their insurance card. This is non-negotiable. If they are hesitant to provide this, wait for the police. Do not engage in an argument. And look around. Are there witnesses? People on the sidewalk, other drivers who stopped? If someone saw what happened, their testimony can be pure gold. Ask them politely if they'd be willing to give you their name and phone number. A neutral witness can completely obliterate the other driver's attempt to lie about what happened. Now we arrive at the most critical part of this entire process for a DoorDash driver. The conversation. What you say, and more importantly, what you don't say at the scene of the accident. Rule number 1 is universal for any accident. Do not, under any circumstances, admit fault. Do not say, "I'm so sorry." Do not say, "I didn't see you." Do not say, "That was my fault." In our culture, saying "I'm sorry" is often a polite way of showing empathy. But in the legal and insurance world, it can be interpreted as a direct admission of guilt that will be used against you with ruthless efficiency. You can be compassionate without admitting liability. You can say, "Are you okay?" You can ask if they need help. But you must not accept blame. Let the police and the insurance adjusters do their jobs and determine fault based on the evidence. Your job is to collect facts, not to offer opinions or apologies. Now for the million-dollar question specific to you as a dasher. What do you say about DoorDash? Let's be crystal clear. You should never ever lie. Lying to the police is a crime. Lying to your insurance company is fraud, which can lead to your claim being denied, your policy being canceled, and even criminal charges. Honesty is not just the best policy, it's the only policy. However, being honest doesn't mean you have to volunteer information that complicates the situation at the roadside. When you're talking to the other driver, the conversation should be strictly limited to exchanging the information we just discussed. They don't need to know your life story. They don't need to know where you were going or where you were coming from. Your employment is not their business. When the police officer arrives, they will ask questions. Answer them truthfully and factually. If they ask, "What were you doing?" a factual answer is, "I was driving northbound on Main Street." If they press and ask if you were working, you should be truthful. "Yes, I was making a delivery." But here's the key. You state the facts and only the facts. Don't speculate. Don't embellish. Don't get drawn into a long conversation about how the app works. Just the simple truth. The real complexity comes when you contact the insurance companies, and the order in which you do this is critical. Step 4. Contact the insurance companies. As soon as you are safe and have all the information, you make the calls. Who do you call first? DoorDash? Or your personal insurer? You call your personal insurance company first. Always. Especially if you have the proper rideshare or delivery endorsement we've been talking about. They are your primary insurer. You have a contract with them. You pay them a premium to protect you. You need to inform them of the accident immediately. They will open a claim and assign an adjuster to your case. When you speak to them, you tell them everything. You tell them you were in an accident and you tell them you were driving for DoorDash. If you have the right coverage, this is exactly what it's for. If you don't have the right coverage, this is the moment of truth we've been trying to avoid, but hiding it will only lead to a denial for fraud later. After you've notified your personal insurer, you then report the incident to DoorDash. You do this through the app. There will be a process to report a safety incident. This will trigger a report to DoorDash's insurance provider. Now, you need to understand the role they play. As we've covered, DoorDash provides excess liability coverage. It primarily covers damages to the other person's car and their medical bills, and only when you're on an active delivery. It does not cover the damage to your own car. That is what your personal collision coverage is for. So when you talk to DoorDash's insurance, Their focus will be on the other party involved in the accident. Cooperate with them fully, but remember that your primary advocate in this process is your own insurance company. Step 5. The next 24 hours. The immediate crisis is over, but your work isn't done. First, seek medical attention. Even if you feel fine, go to an urgent care or see your doctor. The adrenaline from a crash can mask injuries like whiplash or concussions that may only appear hours or days later. This isn't just for your health. It creates a medical record that officially links any injuries to the accident, which is vital if you need to make an injury claim. Second, organize your evidence. Create a folder on your computer. Upload all the photos you took. Write down a detailed summary of exactly what happened while it's still fresh in your mind. Record the police report number, the other driver's information, and the claim numbers from both your personal insurance and DoorDash's insurer. And finally, a modern rule for a modern age. Do not post about the accident on social media. Don't post pictures of your wrecked car. Don't vent about the other driver. Insurance companies absolutely look at social media profiles. A picture of you at the gym a week later could be used to argue you weren't really injured. A single angry post can be twisted to make you look like an unreliable narrator. Stay silent online. Let the official process play out. By following this 5-step plan, you transform yourself from a victim of circumstance into the calm, methodical manager of your own crisis. You protect your health, gather the evidence, and initiate the claims process in a way that puts you in the strongest possible position to be made whole again. But what does being made whole again truly mean? It's not just about getting a check for your car repairs. It's about restoring your ability to earn, your peace of mind, and your financial stability. And this brings us to the darker, more complex corners of a post-accident world, the scenarios that separate the prepared from the ruined. Let's talk about the ghost in the machine. The uninsured or underinsured driver. You do everything right. You have the perfect coverage. You follow the accident checklist to the letter. But the person who hits you has either no insurance at all, or a laughably small state minimum policy that wouldn't even cover the cost of a new bumper on a modern car, let alone your medical bills or lost wages. This happens far more often than you think. In some states, nearly 1 in 4 drivers on the road has no insurance. This is where your own policy becomes your last line of defense. The 2 acronyms you need to burn into your memory are UM and UIM. Uninsured motorist and underinsured motorist coverage. This is the coverage that steps in and acts like the at-fault driver's insurance when they have none. It pays for your injuries, your passengers' injuries, and in some states the damage to your vehicle. Without it, you could be left suing an individual who has no assets, a pointless and heartbreaking exercise. You'd be stuck paying for your own recovery out of pocket, all because someone else broke the law. Adding UM/UIM coverage is often incredibly inexpensive, yet it is arguably one of the most critical protections you can buy. It's a shield against the irresponsibility of others. Now let's flip the script. Let's talk about the scenario every driver dreads. The accident is your fault. This is the moment of truth. This is where having a simple personal auto policy becomes a catastrophic failure. Remember that business use exclusion we've been talking about? If you cause an accident while delivering for DoorDash and you only have personal insurance, your insurer will almost certainly send you a denial letter. They will wash their hands of the situation entirely. Suddenly, you are personally on the hook for the damage to the other person's vehicle, their medical bills, their lost wages, their pain and suffering. DoorDash's contingent liability policy might kick in to cover the other party. But that's not a guarantee, and it does absolutely nothing to fix or replace your car. You're left with a damaged vehicle you can't use to work, no money to fix it, and the looming threat of a lawsuit that could target your personal assets, your savings, your home, your future earnings. This is how people end up in bankruptcy. This is how a simple side hustle turns into a life-altering financial disaster. All of this is avoided by one simple proactive step: adding the proper rideshare or food delivery endorsement to your policy. That small monthly fee, maybe the cost of a few pizzas, is the firewall that stands between you and financial ruin. It ensures that if you make a mistake, your insurance company does its job, defends you, pays the claims, and gets you back on your feet. But we've focused a lot on the cars. What about the most important thing inside of them? What about you? What happens if you're injured in an accident that was your fault? Your standard liability coverage won't pay for your own medical bills. DoorDash's occupational accident insurance is a great safety net, but it has limits and specific criteria. This is where 2 more types of coverage become your personal guardian angels: medical payments coverage, or MedPay, and personal injury protection, or PIP, depending on your state. MedPay is straightforward. It helps pay for your and your passengers' medical expenses after an accident, regardless of who was at fault. It covers things like health insurance deductibles, co-pays, ambulance rides, and dental care. It's typically sold in smaller amounts like $1, $5, or $10,000, but it can be an absolute lifesaver in preventing you from having to drain your savings for immediate medical needs. PIP is more comprehensive and is required in no-fault states. It not only covers medical expenses, but can also cover a portion of your lost wages and other rehabilitation costs. If an injury from an accident prevents you from dashing for a month, PIP is what could keep you from missing your rent payment. Understanding whether you need MedPay or PIP is a crucial conversation to have with your insurance agent. It's about ensuring that a physical injury doesn't automatically become a financial one. Let's put this all together and look at two different dashers. We'll call them Reactive Rob and Proactive Pam. Rob heard about this insurance stuff but thought, "It's too expensive. It'll never happen to me." He kept his cheap, personal-only policy. One rainy Tuesday, he's rushing an order, glances at his phone, and rear-ends someone at a stoplight. It's clearly his fault. His personal insurer denies the claim because he was working. DoorDash's insurance covers the other driver's car, but Rob's own car, his only source of income, has $5,000 in front-end damage. He has no money to fix it. He can't work. The bills pile up. He's stressed, broke, and out of the game, all because he tried to save maybe $20 a month. Then there's Pam. She watched this series. She took it seriously. She called her agent and added a rideshare endorsement to her policy. It cost her an extra $18 a month. A few months later, a similar situation. A moment of distraction, a minor fender bender, her fault. She's shaken up, but she knows what to do. She exchanges information, takes photos, and calls her insurance company's claims number. She says the three magic words, "I was delivering." And because she has the right coverage, her agent says, "No problem, Pam. We've got you covered." Her insurance handles the other driver's claim. Her own collision coverage, which is valid because of the endorsement, pays to fix her car after her deductible. She's back on the road in a week. The extra $18 a month didn't just buy her a policy add-on. It bought her a future. It bought her the ability to continue earning. Bought her peace of mind. Which driver do you want to be? This entire journey, this deep dive into the world of insurance, has not been about scaring you. It has been about empowering you. It's about shifting your perspective. You are not just a gig worker. You are the CEO of your own small business. Your car is your primary asset. Your ability to drive is your inventory. And insurance is not just another bill. It is your single most important business investment. It's the safety net that allows you to take the risks necessary to earn. So what now? I want you to take action. Not tomorrow, not next week. Today. Right now. First, find your current auto insurance policy. Dig it out of your glove box or log into the app. Second, look for the declarations page. Read the fine print. Look for the phrases business use, commercial use, or delivery. See what your policy says. Acknowledge the reality of your current coverage, or lack thereof. Third, tomorrow morning, make the call. Pick up the phone and speak to your insurance agent or company. Don't be timid. State it clearly. "I am a food delivery driver for DoorDash. I need to know if I am properly covered, and I want to add a rideshare or commercial use endorsement to my policy." Use the language we've discussed. Be an informed customer. And fourth, shop around. Your current company might not be the best or cheapest option. Get quotes from at least 3 other providers known for being friendly to gig workers. Use an independent agent if you have to. A single hour of research could save you thousands of dollars and unimaginable stress. This is your moment to take control. You've invested the time to learn. Now you must invest in your own protection. You've transformed yourself from someone who just drives into someone who understands the intricate system they operate within. You are no longer just hoping for the best. You are prepared for the worst. You are a professional. You are a business owner. And now you have the knowledge to protect the business you are working so hard to build. Go out there, drive safe, drive smart, and drive insured.